Hello, my name is Anthony Sicaro, founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer. And a couple times a month or so, I try to do a market update and bring some information to you about what's going on in the environment, the economic conditions, information I think could be valuable to you. And what I want to do, since we're in the first week of November, is I want to take this chance and talk about some tax strategies, ways that you might be able to save some money on taxes and things that you need to be thinking about as you move forward into 2018. So we're going to call this our 10 year-end tax savings strategies video. Now, before we get right into those 10 tax saving strategies, I want to just talk for a minute about Trump's tax plan. We don't know what that's going to look like. It looks like they're going to consolidate our current 7 different tax brackets into 3 different tax brackets. Looks like there's going to be some changes in corporate income. We don't really know what that's going to shake out to be in the end. And so, next year or the year after, then, this video may be obsolete. But I'm doing this video for now, for 2017. What can you do until those new changes come into play? And so I think that's important for you to understand as well too. And of course, if that tax reform goes into play, then we'll update the video at that point. Now, I want to mention something about taxes that I find is often confusing for individuals, just kind of a tax 101. In our society, in our economy, we have 7 different tax brackets at this point that range all the way from 10% in the lowest all the way to 39.6% in the highest on the federal level. And of course, your state has some additional taxes as well if you're in a state that has state taxes. Some states don't. And we're in a progressive tax society. And what that means is that if you're in the 15% tax bracket, then that means that you're going to pay some percentage of your income at 15%, but you're also going to pay some percentage of your income at 10% as well. If you're in the 25% bracket, then you're going to pay some percentage of your income at 25%, some at 15%, and some at 10%. And I find that a lot of people don't understand this. I find that a lot of people, what they're afraid of is they're afraid of doing a lot of aggressive tax planning, because if they happen to get into that 25% tax bracket by $1, then they think they're going to pay 25% on their entire income. And that's not the case. If they happen to be $1 into the 25% tax bracket, then that means they're going to pay 25% on that dollar, which means it's going to cost them a quarter. And the reason I bring that up is because a lot of people don't really understand that, and you could be losing some tax advantages or not doing some tax strategies appropriately if you don't have that basic foundational understanding of how our tax system works. So I think that's important to understand. So with that in mind, let's jump into our 10 year-end tax savings strategies. Number 1, reduce taxable interest. When you get interest from your investments, some of it's going to be taxable, some of it's going to be tax deferred, some of it's going to be tax free. And what I find a lot of people doing is investing in stocks and dividends and mutual funds and other investments that are paying them a lot of interest. And you have to pay taxes on this interest. And just like everything else, this interest, not only would you have to pay taxes on this interest, but that interest may cause you to have to pay a higher percentage of tax on your other income. That interest may cause you to move into the next tax bracket. And that interest may cause phase outs for medical deductions and other things as well too. So by lowering the amount of interest and dividends you're getting that you have to pay taxes on, you're lowering your overall income, and you're certainly going to save a good amount in taxes. Now, what do you do with it? Well, there's municipal bonds that have interest that's tax-free. There are annuities where the interest is tax-deferred. So there are other things to do with it, but just know that that's something that definitely you want to keep in mind and take a look at. And you want to talk to your financial advisor as well to find out what are the other options that are tax beneficial. One of the most, I find that one of the most missed ways of saving taxes is not considering the tax consequences of your investments. I think that's very important. Number one, reduce your taxable interest. Number two, offset capital gains with capital losses. Now, a lot of individuals over the last year have had some capital gains. The market's up about 25% since Trump got elected. And so the markets are up, and a lot of people have some gains in their portfolios, and yet they're really worried about the market like we are. And if you just take those gains off the table, then really you might be missing a big deduction because you'd have to pay taxes on that. But not everyone has gains, and not all of your accounts are probably full of gains. There are probably some accounts that have done worse than others that may have some losses. So if you want to take some winnings off the table and you're going to pay some capital gains on that, then take a look and see if you have other accounts or other investments that haven't done so well that are capital losses, so you can use those two to offset each other. If you just sell a capital loss item, you can only deduct $3,000 of that if it's a long-term loss each year. If you only sell a capital gain item, then you're going to have to pay capital gains tax on that, even if you have capital losses. So in order to take advantage of this, you have to sell the capital gains item and you have to sell the capital loss items as well, so they can offset, either wholly or partially offset, the tax consequences. Now, just a note, a caveat. You don't really want to make investment decisions based on taxes. You don't want to let the tax tail wag the investment decision dog. But if you're thinking about making investment decisions and selling an account with a gain or an account with a loss, then this is a good way to coordinate that. Just make sure you don't miss it. It would be a shame if you sold in a capital gain this year and a capital loss next year, because it wouldn't show up on the same tax year. So just something to keep in mind. Number three, take only what is necessary from your individual retirement accounts or your retirement plans. Especially if you're a little older in life and you need money out of your portfolio to live. If you have a basket of retirement plans and you have a basket of non-retirement plans, what you want to do is make sure that you only take what's necessary out of your IRAs, because everything you take out of your IRAs is fully taxable. And what we find a lot of people do is they take more than they should be taking out of their IRAs, and it causes them to have to increase their income, and sometimes it causes them to move into the next tax bracket. Whereas if you take out of your IRAs the amount that is necessary to get you up to the next tax bracket, and then you take the rest of the income you need from your non-IRA money or your non-pre-tax money, then that's not going to be taxed when you take it. And you can control your tax level simply by taking only what you need from your IRAs or retirement plans. Number four is very closely associated with that, and that's coordinating income appropriately. Now, we mention IRAs and non-IRAs and coordinating the income from there, but there's other things to consider as well too, like Social Security. When should you take Social Security? Should you take it at 62? Should you take it at 70? You have to remember that if you have an IRA account at 70 years old, you're forced to take a required minimum distribution. And of course, the bigger your IRAs, the bigger the required minimum distribution, the bigger the tax break. So if you've got sizable IRAs and required minimum distributions are sizable, going to be a big deal for you and potentially cause a lot of taxes, then maybe what you want to do if you're, in your early 60s or mid 60s is maybe you want to start using your IRA to live off of, spend down your IRA until you get to 70 years old, and then start taking Social Security. So you've then increased your Social Security along the way, and Social Security is taxed really more favorably than your IRAs. So you've increased your Social Security by waiting, and you've also decreased the amount of minimum distributions you have to take from your IRAs when you get there. So coordination of income from the different sources is absolutely huge. And that's something you'll want to talk to your financial planner about, or you can always call us and talk to us about that as well too. Number five, on the reverse of that is you want to make the appropriate contributions to retirement plans. Now, you can only do this if you're working. If you are under 70 and working, you can contribute to an IRA or Roth IRA. If you are any age and you have a 401k or retirement plan, you can contribute to that. And that's certainly a way to lower your taxable income. So that's something you want to keep in mind too. Now, you might be able to make a lump sum contribution. So if you've had a year where maybe you've made more income than normal, then before the end of the year, you want to see if you can find out if, in fact, you can make a lump sum contribution. Maybe you want to contribute, $10,000 at one time, and instead of just contributing check by check by check. But you'll want to check with your plan and make sure that that's something that you can do. If you're self-employed, consider setting up maybe a SEP IRA or a simple IRA to be able to contribute more to. And even if you're not self-employed or you don't have a retirement plan, you can contribute to IRAs. And I think that's important to know as well too, because anything you contribute there is going to lower your taxable income. You'll wind up paying less taxes. Number 6, donate to charity. If you're charitable minded anyway, and you want to donate to charity, then you may want to just take a look at your tax return or work with a CPA or an accountant and figure out where you are. If you happen to be over by a few $1,000s or more into the next tax bracket, well, maybe it makes sense to donate that corresponding amount. So instead of giving half of it to the government, you give all of it to charity. So you want to just make sure your charitable donations are in line as well too. And number 7 is closely related to that as well. Also with regards to IRAs and required minimum distributions and charity. A lot of individuals, a lot of you have IRAs that are sizable that you're over 70 and a half and you have to take the required minimum distribution. And I find that most people that have sizable IRAs really, they don't want to take it. They let it sit there if they could, so they don't need the income. The income is really more of a pain than anything else. And yet a lot of these people, a lot of you are charitable minded. And there's a right way and a wrong way to give to charity when you are taking your required minimum distributions. What most of you will do is most of you will get your required minimum distribution. You'll put it in your checking account and you'll write a check to charity. Well, that's a Schedule A deduction. So a Schedule A deduction is not a dollar for dollar deduction. As a matter of fact, if you understand standard deductions versus itemized deductions, what you need to understand is that your itemized deductions have to be greater than your standard deduction in order for you to get any benefit from it at all. And your itemized deductions are things like medical expenses and mortgage interest and charitable deductions. And if you itemize your deductions and your deductions are greater than your standard deduction, then your itemized deductions are going to be more valuable. But a lot of times, as people get a little older and pay off debt, and especially when they don't have a mortgage payment anymore, paid off your home, well, that mortgage interest deduction is not there. A lot of times they use their standard deduction. Do you know that if you use your standard deduction and you give to charity and your itemized deductions, including charity, is less than your standard deduction, you get no deduction for that at all. It doesn't help you in any way, shape, or form. But what happens now is if you have an IRA minimum distribution, a required minimum distribution from your retirement account, that might change. That might cause your income to go up and now you're going to pay more taxes. So if you simply write a check to charity after putting the required minimum distribution in your checking account or your bank account, it may not help you at all. And it certainly won't help you to the degree as if you do what I'm going to suggest now. And that is, there's one change you can make to be fully maximized as far as your tax benefits are concerned regarding your required minimum distribution. And that change is this. If you're going to give to charity anyway, call the custodian who's going to be issuing your required minimum distribution and have them make the check payable to the charity directly. If they do that, it doesn't even show up on your tax return at all. It's like it never happened, and it satisfied your required minimum distributions. So it won't cause you to pay taxes on your Social Security. It won't cause you to go into a different tax level. It's a complete wash, and that's all you need to do. Call the custodian and let them know that you want the check, your RMD check, payable to the charity, and they'll gladly comply. And it doesn't have to be the full amount, by the way. You can split it in any proportion you want, but the amount that you give to charity won't show up on your tax return. So that's important to know as well too. Number 8, you want to make sure that you do itemize your deductions properly. And we talked about standard deductions versus itemized deductions a minute ago, so you have a better feel for how it works. But I find that a lot of people don't keep adequate records, and so they miss a lot of itemized deductions. So on your itemized deductions, here's generally the main items that most people take advantage of. You've got medical and dental expenses. You've got real estate taxes, you've got property taxes, you've got mortgage interest, you've got charitable deductions, both cash and non-cash, And you have your tax preparation fees as well too. Those are often the Schedule A deductions that are used, and yet some of them are overlooked. A lot of times the medical deductions are overlooked. A lot of people pay cash to have dental work done. Not a lot of good dental programs out there, and it can be very expensive. Don't forget you can write that off. You can also write off your long-term care insurance premiums, your health insurance premiums within certain guidelines and certain exceptions as well too. You want to talk with your tax preparer about that. But I find that a lot of people miss deductions, and it's not because they don't know they can write them off. A lot of times they know, but they don't have a good record-keeping system. So maybe for next year, maybe you make it a goal to have a good record-keeping system so that you can save your receipts and itemize your receipts, and then make sure you don't miss a deduction. Those are big, though. Those are big. Number 9, you want to pay off your debt, even pay off your mortgage. Let me see if I get this right. I'm a financial advisor, and I'm telling you to pay off your mortgage? Possibly. But I find that most financial advisors will tell you don't pay off your mortgage. And in some situations, I think that's good advice. But in many situations, I don't think it's good advice at all. I think in many situations, it's self-serving. I mean, think about it. If an advisor tells you to pay off your mortgage, maybe you owe $200,000 on your mortgage, and you got $500,000 in investment somewhere, maybe in the bank. Well, if you take $200,000 of that $500,000 and pay off your mortgage, then that's $200,000 less that he has to invest. That's less fees that he's going to get. So unfortunately, I see that recommendation made a lot where I really have to wonder why the advisor made that recommendation. But here's the bottom line. If you pay off debt and you pay off your mortgage, then you need less money every month. If you need less money every month, then you need less income every month. If you need less income every month, then you're going to pay less taxes every month. And it could have a compounding effect. If you have less income, not only might it lower your income tax, but it might also lower your Social Security tax. So you could be saving 2 taxes or 3 taxes in one by reducing, by lowering your expenses every month. And a good way to do that is by paying off the mortgage or paying off the credit card debt. And last thing, very similar, item number 10, tip strategy number 10, it was to reduce your lifestyle. Now this, of course, this has to make sense for you. If you're living the way you want, I wouldn't recommend that you upend your entire life if in fact the only purpose for doing that is to save money in taxes. But a lot of people, when they retire, they want to get out of Dodge. They want to make a change. We have so many people tell us that they don't like the traffic in California. They don't like the expense in California. I was sitting down with an individual, I think it was yesterday, that's exactly what he was talking about. And he was essentially saying that he just wants to move to a different part of the country. Doesn't really care where. Different part of the country, a lot less expensive. If you reduce your lifestyle in that way, because it's something you want to do, then you'll also save a lot of money in taxes as well too. Why? Because of what we talked about just a minute ago. You need less income. If you need less income, then you're going to pay less taxes as well too. So I hope that helps. I hope those 10 tax saving strategies are something that at least you can get a couple of points on a couple of them. I do want to put a couple caveats in there. I wasn't able to extrapolate on really any one of these points. I could talk about an hour probably for each one of these points about pros and cons and things you should be thinking about. So I really don't want you to just go out and do one of the things I said immediately right away. I want you to know that this is available and talk to a professional. If you have a financial advisor, then certainly I want you to talk to that person. If you have a tax person, maybe you want to talk to that person as well too. And you got to be careful because sometimes they overlap in their knowledge. And sometimes you may want to ask the right person the right question. Sometimes financial advisors who are really not qualified will give tax advice. And sometimes tax advisors who are really not qualified will give it financial advice. And, my situation is fortunate. I've been in business for over 18 years. I'm a financial planner. I own a registered investment advisory firm, and I also own a tax firm too. So I kind of come at it from both sides of the table. But just be careful where you get your advice. And if you're a client of mine and you want to know whether or not, there are some tax saving strategies that we should be thinking about, well, you can almost be assured. I mean, I can almost say this with 100% certainty. You can be assured that we're doing everything we can at this point to maximize your tax saving strategies. But if you want to double check, feel free to call me. Call me, get on my calendar. We'll look at your investments from a tax saving standpoint. We'll see if there, any way that we can reduce your taxes even more. If you're not a financial planning client of mine and you would like to find out whether or not there's any ways you can save money on taxes, what I'm very open to doing is I'm very open to scheduling a quick 15-minute phone call with you and taking a look at your return with you and helping you, asking you the questions that are necessary, having a hard time speaking English, necessary to helping you figure out whether or not you can save money in taxes. And really all I would need to do that would be a copy of your most recent tax return. So if you want us to look at that tax return for you, all you have to do is call my office. The number is 818-887-6443. Ask for Jerry Alcala. He's our client relationship manager. He's the one that controls my calendar. And just let him know you watch this video and you want to have me review your taxes, and he'll make sure that he gets you on the calendar. So again, my name is Anthony Saccaro, founder and president of Providence Financial and Insurance Services, right in the San Fernando Valley on Ventura Boulevard in Woodland Hills. Also host of the Providence Financial Retirement Show. You can learn more about us at our website at www.providencefinancialinc.com. And while you're there, click on Facebook, like us on Facebook. We keep in touch with you that way. And follow us on YouTube. If you're watching this video and maybe you got it in a newsletter or maybe a friend shared it with you or so on, then make sure that you go to our website, Providence Financial Inc., click on the YouTube link that's right on our homepage, and click follow. And you can follow me, and every time I do an update like this, you will be notified. So thank you for watching. Hope it helped, and look forward to talking with you next time. God bless.